Welcome to Data Myths podcast with your hosts, Brian and Melinda Gagnon.
So, a little about us. I'm interested in how tech helps us improve our lives. I have 20 years experience in digital communications. I'm an ex-Googler and now help launch new companies and products.
And I've spent 20 plus years evangelizing tech at some of the world's largest companies. Whether you're a dataphile or a dataphobe, we have something for you on this podcast. So get ready. Let's go.
Hi, Brian. How are you?
I am awesome.
Glad to hear it. It's been a pretty awesome weekend.
Yeah, I agree. We did a little travel, so it's nice to be back in the studio.
Yes, very nice. We recorded a lot before we had our bit of travel, so it's nice to get back on the regular swing of things. So when we've been looking at what's been hot in the news with tech right now,
there's a lot.
Yeah, and I think there always is, fortunately for us tech lovers. What we've been seeing a lot recently is some interesting shift in investments that's caused you to kind of think about, well, where is the value in some of these tech companies? We've seen a real emergence in these type of aggregators, sharing platforms, taking advantage of the gig economy, which gave the rise of these brokers. But then you have companies that have been around for a much longer time that are really tapping into a more consistent value base because they own property, items, what have you. And it's an interesting dynamic that's playing out.
So I think this podcast is going to be about brokers and owners then.
Yeah.
Let's talk about brokers and owners. And I think sometimes with the owners piece, the challengers in the last 20 years have been more on that brokerage side where it's build a cool app, aggregate a network of people, and then share something out there, whether it be gig economy, experience economy, etc. So where do you want to go? There's a lot of places we could talk.
Yeah. I mean, I think the first big thing to think about, well, what are these types of services? Let's just run down through what those are first. So we're talking about a broad swath of companies, right? When we're thinking about this. So it's Airbnb, it's Uber, it's, a company like Netflix. So it's aggregating a service and allowing people to tap into that.
It's even Amazon and Walmart, which I know we've talked a ton about, but when you look at it from a real estate perspective, Walmart owns a ton of real estate in comparison to Amazon. So yet another broker versus owner.
And it also starts to fall into in that scenario, the online versus offline world as well. So when we've seen the rise of extremely valuable companies that live, one, exclusively online, two, get their value from aggregating and surfacing information, or three, create a new economy essentially by virtue of aggregating and outsourcing,
right?
Uber. These are some really different business models.
So let's define this a little bit. So what's your definition of a broker or an aggregator? And are those two interchangeable in your mind? I kind of have my thoughts.
They don't have to be interchangeable. Oftentimes, if we're talking about such a broad group of companies, that I think a broker is a better term to describe all of them. I mean, when we're talking about literally what is the commonality between an Airbnb, an Uber, and Netflix, it's really more of being a broker, but they are also aggregating information to make it accessible. That's part of their big value.
Well, and if we think about that, let's rewind the clock a little. So some of the early brokers, stockbrokers, insurance brokers, they didn't actually create the stocks or hold the stocks and all of that. they actually made it accessible to people that weren't on Wall Street. So they were that intermediary. Same with insurance brokers. They didn't create the insurance. They were brokering it for somebody else.
Right, right. And that's really, when we think of this more flexible broker model, the model that lives online and is accessible to so many people, that created a whole new value play.
Yeah, that's really interesting. So let's get specific about one of these matchups, right? So Airbnb and Marriott have both been in the news in the last couple of weeks. Let's talk about that. Let's start there.
Yeah, it's pretty interesting what's happening in that space, because Marriott, I mean, that's the world's largest hotel company, and they are just now starting to get into having home shares, essentially. So doing what Airbnb does, really accommodating the leisure traveler, the traveler that's traveling with family, and allowing them to rent a home that is managed by this array of property management companies that they're now partnering with. And it's brand new. I mean, their site isn't even up yet.
Well, and if you think about it, though, if I was Airbnb, I'd be kind of nervous about that, because Marriott has 23 to 25 billion worth of assets in properties.
Yeah, they have 7,000 hotels, 130 countries. They're massive, and their loyalty program is huge as well. And now that they can also have the Airbnb-esque offering, their customers can use their points and build on their loyalty program. So it all just fits very nicely together.
Well, and I'm a loyal Marriott guy, so I would say I've used Airbnb a little bit. I've used VRBO, their competitor. One of the major downsides is consistency, and there's not a lot of consistency. I can't use all of the points, the millions of points I've banked over the years. So it's interesting to me.
Absolutely. And the space that they're looking to fill, having hotel rooms works really well for the business traveler. And something that's more like Airbnb is more appealing to the leisure traveler, and certainly to families. So Marriott's seeing this and responding. Now, Airbnb, they've been, continuing to be fairly aggressive with their acquisitions, and they only had one last year, but this year they've already acquired 2 different companies.
What types of companies are they acquiring?
For the most part, it's really a company similar to theirs that focuses in a particular market.
Okay.
More often than not, that's who they're snapping up.
So they're building out services around their brokerage and around their app, essentially.
Yeah, like for example, January of this year, they acquired a company out of Denmark. So, they talk about that they broker. They don't call it the word broker, obviously, but they connect people with places to work and play around the world.
Interesting.
And they also had an acquisition just a month ago with a company called Hotel Tonight, and it's a booking platform, and it allows you to get a hotel the same day.
Okay, so now they're starting to dabble in the hotel space a little bit, in the brokerage of hotel space.
Yeah, and that, Hotel Tonight, that's a similar activity that, your Expedia and TripAdvisor type of travel aggregators perform. And that space has changed massively over the past 10 years. Just the value that they're bringing is debatable, quite frankly, if it's even there, because they're not surfacing the best deals anymore. The model has shifted.
So I've watched, and I know you have as well, just by the nature of sharing a TV with me, we've watched a lot of Hotel Impossible. And one of the things that I really take away from that show is that understanding pricing and understanding what everybody else's vacancies are in town is the name of the game. So that data game has always been really critical to making sure that you're pricing what you have at the highest possible price for what the market will bear.
And that acquisition and the access to that data is really easy now. And hotels are no longer giving a block of rooms, for example, to Expedia or whomever. They're just able to say, hey, book with us directly. And so that value is no longer there. And there are also aggregators upon aggregators. So the fees are small fees, but they're starting to add up. So not only are they not getting access to actually lower prices, there are just so many players bombarding this space that, by the time you're done with fees, anything that looked like a deal, once you get through and, oh, I can fly from Boston to Miami for $50, but my flight back is going to be $600. Oops. And that's how they get you in. Usually those deals just aren't real.
Right. Or you don't get any loyalty points. You also get no privilege to, change any flights or anything like that. And your customer service is at the absolute bottom.
Or you get the middle seat and you have 5-hour layover, those wonderful things.
You get the only seat on the plane that has a hole in it and a door that says occupied.
Oh, jeez.
So
that would be rough.
Yeah. So let's get back to, the Marriott and Airbnb thing. I think it's interesting. So Airbnb is one of the few new companies in the new world internet order that's actually making money. So to kind of round off, they made about $100 million last year on, billions of dollars of revenue. So that's pretty good. That's substantial. But Marriott pretty much prints money at a rate of $350 million a quarter. So,
and it begs the question, where has Marriott been for the last few years? Why did it take them until now to cook up this idea of working with property management companies? But it's clearly not going to be something that is a potential landfall, considering it's not going to be the core of their business. But my sense of it is they've realized, seeing Airbnb's performance, seeing VRBO, that this is a trend that's here to stay, and it connects with a user base that matters.
Well, and it's arguable. So Marriott has something like 450,000 rooms, I think in North America alone. I'm not positive of that stat. I'll have to put that in the show notes. But when you think about it, that's a lot of data. And those are rooms that they control the cost of. Those are rooms that they have a lot of intimate knowledge about the people purchasing, spending, how long they're staying, all of that. So I would imagine that they have much, much more data because they've been at it for many, many tens of decades at this point.
Absolutely. And this is something that it's, nothing that's cast in stone, certainly, but Hilton is also looking into doing some kind of home rental business. Hyatt's considering it as well. And really the notion in the past is that Airbnb, Expedia, et cetera, they really haven't been big competitors until now. So this will be interesting to see if these huge hotel chains start getting into this business. Is that going to start to erode Airbnb? The travel aggregators, the game is already shifted. That's already been eroded.
Well, and when you can say, hey, join our loyalty program, you could stay in a hotel or you could stay in your favorite neighborhood, somebody's house or whatever for a longer stay potentially, that's going to take a lot of business, I'm guessing, from Airbnb.
You would think, and it is the trust factor. It's the ease of having different options. It's trusting that level of quality. It's having loyalty program. And the biggest risk, we all know, with Airbnb or VRBO, you just don't know the quality. You're hoping that the reviews you read are accurate, that something didn't change since the last person was there, but you never know.
Right. And if you think about it, right, so Marriott was actually late to the game on basically timeshares, right? But they got there and then they actually started taking a pretty big chunk of the market.
And that was really to get in on the whole family vacation type of consistent vacationers, essentially. So it's what is very interesting with all of this is these different ways to get at families who are vacationing, and even if it's not a whole family, just people who are looking for these vacations in consistent areas. And the business travel space seems to be pretty consistent. No one's trying to solve for, how do I engage with the business travel in a different way? The hotels seem to be solving that very well.
Yeah, no. So this is interesting. So this is a place where if I was an aggregator or a broker, I would probably start to worry or come up with, an adjacent model.
Right. And the thing is, with Airbnb still might win out over Marriott just because of volume, and Marriott's going to have certain quality standards in place, and maybe by virtue of that, Airbnb will still have a niche that, well, maybe they have plenty of places that maybe aren't quite as nice and polished, but it's the deal that a family's looking for, so it all works. Because Airbnb has almost 5 million rooms listed, Marriott has 1.3. So when you think of it that way, Airbnb's reach is huge.
Do you think some of this will come down to regulation? Because let's face it, Airbnb, Lime, Uber, you name it, the new economy companies have just kind of jumped into the market, not necessarily cared so much about regulation, kind of did an end around, and now are running into a bunch of headwinds. It's probably arguable that Marriott's already on the radar of some housing board or a standards and accommodations board, right? Because they're already scrutinized to that. Is that a word? Jeez.
Scrutinized is a word, though.
Scrutinized.
It's okay. I know what you're trying to say. It's all that matters.
Yeah.
Details.
Making up words like Dan Quayle, for God's sake.
Dan Quayle. Wow.
Anyway, potato. So let's get it back on track.
Okay.
Yeah, or
If we
not.
must.
Or not. So I think we talked this, around a bit. Let's go into a different kind of category. Let's talk about Tesla and Uber.
Let's talk about Tesla and Uber. So Uber is interesting. I mean, many reasons. They also are going to IPO later this week, so we'll see what happens there. Stay tuned, everyone. But what's interesting with Uber and why Uber took off like it did was really a matter of where we were just in our economy. So
I was customer 51 on Uber.
Congratulations. That's really cool.
It was very different back then.
A moment in history. So really with Uber, so the Great Recession happened, right, to 2008, and the job market tanked. So the gig economy had a chance to develop and then flourish. So Uber is there, perfect timing. People were excited to get in on this new way of earning money with a flexible schedule, all of the benefits of the gig economy. And they were making decent money and happy with it. And what has happened over the last few years is, well, one, there are additional competitors in the space. So they're vying for
Lyft and
yes,
all of the others.
So they're vying for drivers. And also the job market has improved. So we now have the highest employment rate that we have had in 50 years. It's pretty incredible. So not only the job market's healthier, maybe people don't have to rely on the gig economy and just take work where they can get it because they can get a full-time job with all of the benefits that come with a full-time job. And they're starting to use Uber as maybe a little supplement or ditching it altogether.
My Uber usage has actually gone down quite a bit.
Why is that?
Mainly because in many cases I go to an airport, it's like they've cordoned them off into some weird section of the parking garage.
Especially in Las Vegas.
Especially
it's
in
the worst.
Las Vegas. we were there the first week that they started doing Uber in Las Vegas, and it was a shit show from day one. Let's just
It
call
still
it
is
what
a
it
shit show.
Yeah,
Yeah.
it's Las Vegas. Come on. And so I think as these regulations and as problems, started to occur, and obviously the taxi medallion owners definitely have a lobby, right? And they have some pull. Everybody's waiting in queue there. And next thing you know, they see everybody going over and just jumping in a car. They complain.
Right.
And now almost every airport that I've been to in recent days has a section that's for, ride share. And it's usually a little further away than the taxi. So there are some cases where if the taxi line's not too bad, I jump in. Why? Because I could pay with a credit card now, and it's pretty darn easy. In the past, that was a mystery to yellow cabs or cabs in general. And with Uber, it was pretty easy, and many of these cab companies are starting to get apps now. And yeah, that's some of it.
Yeah, it makes sense. And it's always going to be a matter of convenience for the customer. And, when you have Uber and Lyft, now that they're becoming a little more mature, their investors are wanting them to actually start turning a profit. The pressure is on, and the climate really isn't helping them, especially when you're seeing these kinds of really high churn rates with their, I don't want to call them employees, they're contractors, right? They're drivers. And there are even companies now that can actually help find drivers for Lyft and Uber because the churn rate is so intense. I mean, sometimes they even have up to a 500% churn rate. So when you think about the money that is wasted, or I guess maybe it's just necessary, but in onboarding new drivers who just churn, that's significant.
Wow, I didn't know it was that high, but I've always seen so many of the drivers have both Lyft and Uber. So I'm guessing they're just playing both fields.
Oh yeah, everyone has their different take on which company they like better, but usually they're ping-ponging between the two.
Okay, so tons of competition. So Lyft went public about a month ago. Their stock's down almost 20%. Came out a little bit higher out of the IPO, but now it's back down to earth. Some of that is in their books look a heck of a lot more healthy than Uber's. And so in Uber's S1, which is basically their public announcement of IPO, they came out and said, we don't think, or we don't know if we will ever be profitable. That's like pets.com 2000, and they're hedging on the backs of Uber Eats and Uber Freight for them to have any hope of making profit.
So when you're diversifying like that, it seems like there could be some pitfalls in the assumption that these sub-services are going to eventually carry the company.
That seems like a lot of risk, right? And we're not here to give stock advice, but
Certainly not.
when I think about it, right, that's a lot of risk. And sure, they have a sufficiently large network, but if a network is not profitable, it's not sustainable, right? We've seen a lot of things that haven't been profitable.
Absolutely. And I think with Uber, it absolutely is this vision for the future that isn't that near of a future, because really the CEO of Uber, and I always completely butcher saying his name. Anyway, basically what he envisions as the future is most people won't own cars. You'll, hop on your electric bike or your scooter, you'll summon cars, and he's kind of envisioning this new state that ownership doesn't matter, and it's all about just accessing this share economy.
So I'm gonna stop you right there. So ownership doesn't matter unless if you're the person that someone has to own the asset at some point, whether it be that company or whether it be an entrepreneur that goes and, whether it be real estate, and somebody goes and buys apartment buildings, somebody has to own it. So let's insert Tesla. So Tesla, very different company than a traditional car manufacturer because they are building the hardware. They are building a lot of the AI. They are building the software, and they're able to update it over the wire, right? Or over the air, I should say. So when you think about it, Elon Musk has been saying, hey, we're building cars to be an appreciating asset, not a depreciating asset, because we're going to be able to continuously add value to cars over time. And that's not something that traditional auto manufacturers have been able to do. So that's really interesting to me. The other thing that he's been talking about that I've been saying all along should be kind of the new gold standard is if you take that gig economy and you apply it to an autonomous something, right? Now you could take that smart vehicle, and when you're not using it, your garage door opens, your Tesla drives out, and it goes and picks up a fare somewhere, and it's making passive income for you. So when stuff like that starts happening, this is where I argue a little bit. I think people are going to pretty quickly say, I want to own the asset because it's making passive money.
Right. Well, and also then we have this shift because Uber right now is tapping into this idea of the gig economy and also the sharing economy. So yeah, you take the drivers out. Well, the gig economy's gone. Now it's a share economy, and the value to Uber is still in the network, but the network is just obviously operated in a completely different way.
And so when you think about it, right, Tesla owns, and Tesla's, building somewhere in the neighborhood of 300,000 to 400,000 cars a year now, almost. They've had them out for almost 10 years now. So they've got a pretty big network of actual landed assets out there. And if they can, over the air, start to upgrade some of these, maybe some sensor changes and stuff. They also own some of the charging stations and infrastructure. They also own companies that make the solar, right? So that you can lower the cost of that. When you start thinking about it, they own that whole infrastructure top to bottom and really control it. So they're not really a broker, but they're going to start going into that broker space. And so I'm thinking that Lyft and Uber's jobs, they better be selling a lot of Uber Eats, because I think that companies like Tesla are coming for them.
Agree. And also when you think of the viability of an autonomous network of vehicles, you need to have places where the fleet can be deployed from as well. So when you think about that, your comment about having superchargers in different locations, right now it's mostly sales showrooms, so it's not as if those are huge and can hold a lot of vehicles, but it's still property, it's still physical locations across the country. So that is something that's a significant investment that's already underway for fleet management that Uber doesn't have, Lyft doesn't have. So it'll be interesting to see how the future state starts to roll out. And Tesla's much farther along with their autonomous vehicle than Uber is. Uber is investing heavily in it, but it's just not quite there.
Yeah, and Uber is also losing money hand over fist at the rate of, hundreds of millions of dollars a year. Granted, they're making billions on the top line, but when it gets to the bottom line, they're losing quite a bit. And so, a couple challenges with this, right? Obviously, you could make the argument that, hey, if autonomous vehicles go out and they charge, at some point they go out and they do services, they're going to have to get charged at some point, Do they come back and send you a message saying, plug me in? How does that work? The other piece is wear and tear. The other piece from there is how does it actually compare cost-wise? Well, I ran some math, and at $2.50 a mile, which is, like a major city taxi rate, based on that, you could probably make between $10,000 and $12,000 a month after you back out all of the major costs of owning a Tesla.
Right. Yeah, and the thing is, when we think about where this is all heading.
Did I say a month? I meant a year. $10,000 a year.
Okay.
Right. So if you think Model 3, that'd be like a 4 to 5 year payback.
Yeah. And when you look at the vision of the future between these two companies, Tesla certainly has the more audacious vision for the future. And where Uber wants to end up, but Uber's grand vision is really kind of the next step on Tesla's much grander vision. So, if we were betting, my bet would be on Tesla.
Well, yeah, and I think they've got some intermediary issues to get past, but as far as the long-term vision, I think it's going to be interesting. And then you start to add in all of these other companies like GM, Ford, Volkswagen, you name it. I think I read somewhere where 25 companies right now are working on level 5 autonomous vehicles. And so when you think about that, here's the really interesting part, though. The only one that's really building their own autonomous AI engine, so to speak, is Tesla. So they have built all of their own compute and processing. Most everybody else is using NVIDIA's engine. And right now, as it stands, Tesla's engine is a heck of a lot better. They say it's going to be better for 3 to 4 years. That's a pretty major leap in technology time.
Well, and that's just case in point that they're playing the long game here. So long that sometimes people are, especially, investors get a little scared of, is this crazy? But that kind of boldness and preparing for the future, that will get you so far ahead of the competition that when that day comes, everyone's just left in the dust.
Yeah, no, I couldn't agree more. So yeah, I don't think I would want to be a broker or an aggregator in either the shared ride space or anything like that. I think that's going to be a road to probably nowhere, unless if they come up with some other aggregation points.
Agree, especially with ride sharing. And another point that you just can't ignore with the demographics of our country, 70% of people live in rural or suburban places, and they still want to own their own car. So yeah, maybe that car will be autonomous someday, but they probably won't want to share it very much. They need their car. So, you just have to kind of ground all of this in the composition of the user base and be real about it.
Well, and to talk about that, right, that also becomes an equation of how far are people's houses from average services? If it takes 35 or 40 minutes to get to Home Depot, for instance, or to the nearest Walmart, which that's highly unlikely because I think everybody lives within 20 minutes of one. But when you start to get to the fringe of that cycle time to be able to go pick someone else up, get them to a potential service that they want to go to, becomes really sufficiently long. So they need to be able to, take that out of the equation, right? And so the vehicle is going to be less available.
Absolutely. So let's shift gears and talk about a totally different category and stitching all this together. So Netflix and Disney.
That's completely separate and different.
Yes.
But the same.
So yeah, we're drawing this comparison among so many different industries, and it's I don't think it's a stretch. I think it's creative.
It's a tangible asset. Tangible asset versus an intangible.
Yes. What we call as tangible is maybe, it certainly has to change among these very different industries. But when we think of Netflix and Disney, the game has changed drastically in the last couple of months when Disney has announced that they're creating their own streaming service. And guess what? Netflix, you won't have that content anymore. And that's been a significant part of their programming. So now it's again this kind of play between Netflix, their roots being an aggregator and a point of access, to then getting into we are going to start creating our own content. So 2013, House of Cards, talk about like an amazing first attempt of creating original content. So that was Netflix. And then Disney is obviously, the king of creating original content, and they're starting to get in the streaming space. So now it's all starting to meet.
Yeah. And that's really interesting. And when you think about it, that was an access issue. So Netflix fixed an access issue. Same with Spotify, same with, Apple Music, the whole 9 yards, right? They've all been fixing access issues.
Well, and when you put it that way, that's such a great way to compare across all these categories. Airbnb fixed an access issue. Uber fixed an access issue. When you now have the access, well, if that becomes just table stakes, the real value then shifts. It's no longer about access. It's about the tangible thing. It's about the room, the house. It's about the original content. It's about the actual car and what it does. So you describing that way, I think absolutely crystallizes like what this commonality is among these very disparate industries.
Well, and this is also, let's take it to Main Street, Wall Street, all of those streets, right? Walmart, and I know you're doing the happy dance over there because you just nailed it home. But, Walmart wasn't maybe as accessible to all different types of products. Amazon had an opening. Traditional bookstores didn't have every book that you could ever imagine. Amazon fixed that.
Yeah, absolutely. So when we think about Netflix and Disney and how I don't want to say they're meeting in the middle because they're not. They're still very, very different. But with Netflix, their growth is really in developing original content. So they're estimating to spend $12 billion this year. Actually, no, it's $15 billion. $15 billion this year. It was $12 billion last year. And that's going to keep increasing. So
that's incredible. That's
the race is on. Yeah. Amazon is obviously a huge player in creating original content. So the fact that you need to invest in that is where the real value is coming in.
Well, and that's becoming a really pricey game, right? And when you look at Netflix specifically, they have built out a whole lot of content. And when you look at Disney, they have a ton of properties. They've got Marvel, they've got Star Wars, they've got all of the different animations. They've tested and proven that stuff out over, 60, 70 years, right? And they've had some failures too. Amazon's just pumping out content. And I don't know if it's good content. I mean, there's very little that, and I guess this is obviously completely subjective. There's very little that I'm like, wow, that's amazing. There's a few glimmers of hope, but they're spending a lot of money to try to spend out of not having any properties for themselves.
Yeah. And I think the Amazon rate that I've seen is around $7 billion. So Netflix is certainly outspending, and that could certainly be why. But, when we think about the future for entertainment streaming services, is the next big play going to be some kind of deal maker that aggregates all of the different streaming platforms because it's becoming really fractured.
I think they call that a cable company.
No, please don't say that. Please don't say that. We're
Well,
going full circle.
That's what they did. That's what cable companies did. They took all of these different networks and they put them on one cable.
But I don't want the network. It needs to be something more sophisticated that surfaces it by genre, or you can actually pick the shows that you want to watch and pay by show or something like that. Because, deliver me from cable. We were some of the first cord cutters, I think, weren't we?
Yeah, and we just cut
now.
Netflix last week because.
Well, now we're on to HBO. Why do you need something you're not watching? And that's the beauty of the flexibility with it.
Well, and when you start to look at the content and you look at, Fox and Comcast and Disney and all these companies that are going to pretty soon be taking all their content off of Netflix, they better hurry up and innovate and come up with some darn good shows. And coming up with darn good shows, that's not like writing a new app or writing some code or solving something mathematically. It's very subjective.
Well, and it's also it's so fascinating to see that, what was it, 3 years ago, where all the major networks said, we don't need writers. Let's just do reality television. This is going to be great. And sure, there was a lot of interest in that, but the real big successes have been with great content. I mean, look at Game of Thrones. I am a huge Game of Thrones fan, hence the move to HBO right now.
Winter is coming.
It's amazing.
It better not be.
It's amazing. So yeah, I mean, I think when we think about the overall value play, when we have access, then it comes back to, okay, what are we accessing? And is this a cycle, right? So now the game is really centering on what are we accessing? How do we make that better? How do we serve the user, the customer in a better way, because they can access whatever they want.
Well, and so here's the interesting part. I think about it from the data perspective, right? I think that obviously Netflix has a ton of data and a ton of data on us. But when I see my recommendations, it kind of keeps falling into the same genre. It keeps falling into the same stuff.
It's unintelligent.
And it's not that intelligent. So I might argue, well, Disney doesn't really have all of that intelligence on people. They probably do, though, because they've got box office receipts, right? In some cases. So I don't know, just something different to think about.
They don't have it, they can build it.
Yeah,
What their competition isn't so far ahead that's a big deal.
So I think in closing, right, so these are three just very different examples with new and old companies. But I think the general story and theme is that being an aggregator or being a broker may not be enough if you don't start to also mix in owning some assets and having real tangible things like some of the traditional companies, because the traditional companies are getting to that barrier to entry and they're doing it really well, and they already have a big network.
Yeah, that's a great way to summarize it. And it'll be interesting to see what happens with Marriott's program. I'm excited to try it out when the site's up. Can't wait. I'm going to be checking it out. I am as well.
So, all right. Well, hey, I guess, thank you for all the good mental stimulus on this one.
This is one of those topics that I knew there was some kind of common thread here, but you had to just keep following the thread to figure out exactly where it was going. So Thanks for walking through that.
Well, thank you. And I'm looking forward to expanding on this because I think there's just so much that we could talk about on this topic.
Yeah, absolutely. Thank you.
All right.
Thanks so much for listening. Please like, subscribe, and share. And if you have a question or an idea that would be great for us to include on the next episode, we would love to hear from you. Just send us an email at hello@datamist.com. You can also send us a note on LinkedIn, Twitter, or Facebook. And finally, want to give a big thanks to our sponsors, Infonomic Data and Uprise Partners. Thanks so much, everybody. We'll catch you next time.